the expectancy of trading strangles. It's kind of a little bit of a history lesson, stuff that we've covered before, but I think it's a different view. Let's take a look. A lot of the same takeaways, but just interesting, different way to look at it. We usually examine and elevate our trading strategies using metrics like P&L, probability, profit, risk, and volatility. This time, we're going to try a new measurement, the expectancy. Have a little fun with this, Pat. The expectancy. The expectancy is, and we get a lot of emails from customers. That's why we did this. Talk to us about expectancy. The expectancy is a statistical measure that estimates the average amount a trader can expect to win or lose per trade. By understanding expectancy, traders can determine which strategies align with their goals and risk tolerance. We've never really looked at it this way, but we thought it'd be fun. Let's go to the next slide. So we used the expectancy formula. We did not write this ourselves. And again, we've always said this, though. Expectancy is only valid with a large number of occurrences. I think every single live show I've ever done, I've talked about if you have a certain expectation for what you're going to do as a trader, you need to create enough occurrences. Otherwise, that expectation doesn't mean much. So a positive expectancy ratio indicates that a trading strategy is expected to yield a profit over the long term, while a negative ratio suggests potential losses. The larger the positive ratio, the more profitable the strategy is expected to be. So from other tests, we know that selling options when the IVR is higher tends to generate better performance. So what insights does expectancy provide? We analyzed the SPY 45 days, 16 Delta Strangles over the past 20 years. We recorded their performance and the expectancy. All positions were managed at 21 DT. We used all of our optimization in this. We tested this strategy under 3 scenarios based on IVR: below 20, between 20 and 30, and above 30. And we already know the answer. Above 30 is going to be better. But let's see.
Significantly better.
But the question is, how much better? So as expected, trading in low IVR, below 20, the markets had greater success rates, but the average profit was the lowest with the highest average loss. Trading when the IVR is greater than 30 gave us the opposite results. Which scenario has the highest expectancy? And do all these scenarios have positive expectancy that we prefer? So as you can see here, the win rate is going to be highest when the market doesn't do anything, but the amount of money that you make is going to be the lowest. The loss rate that shouldn't change much across the board, but the average loss is obviously going to be greater because you make less to lose more. But let's take a look at the next slide. Let's get into that little expectancy story. So the Strangles expectancy and the expected return per dollar of risk are much higher when IVR is elevated. We've been talking about this for 13 years now, with a favorable risk-reward ratio of risking nearly $3 to make $1. This aligns with our findings. Trading in high IVR markets benefit premium sellers the most. Due to the higher average losses when trading in low IVR environments, the expectancy has been actually below 0. So this gets back to kind of our, a little bit about all our discussions about, why we do things with high IVR. But you can see here, the expectancy per dollar of risk is actually a negative number for SPY strangles when even the 16 Delta Strangle, when the IVR is below 20. That's why we cover there. Between 20 and 30 is very much a toss-up, but you can get away with it if you have to have something on. Well,
if that's what the market presents, right? I mean, there are many times when IV rank is just low. I mean, volatility is low.
And
everything
is low.
So change your strategy a little bit too.
And you can't.
But to put on strangles with very low implied volatility like that, I would look to kind of, mitigate that risk by maybe doing an iron condor, maybe wider than a $10 wide iron condor, but mitigate that risk and that volatility risk by going a little bit wider.
I think that this is a really interesting study and really one of the best slides we've put together on this, because people have always asked, about expectancy per dollar of risk. And when the IVR is over 30, like it is now, there is a reasonable, we used to say expect, like 25%, right, on average, right? But this is so much clearer that rather than give some kind of like broad overview, just saying 25%, I really like this, where it says if the IVR is over 30, the expectancy is about, 31 cents per dollar of risk. But if it's between 20 and 30, it's about a wash. And if it's under 20, it's a negative number. That's really good.
This is good. You're right. Yep, you're 100% correct.
Yeah, that puts a lot more context than we've ever done before. I like it. Kudos to the research team for really nailing this thing. Let's go to the next slide. So some of the takeaways here. The expectancy ratio is a unique but simple way to estimate potential average profit or loss per trade. It confirms that trading in high VR markets yields better performance, and trading SPY strangles in high IVR markets provides approximately a 3-to-1 risk-reward ratio with a success rate of almost 70%. That's